Coming in, flex. I just wanna win.
Hi guys, I'm Ben and welcome to Motivation to Invest. Our mission is to motivate you to invest for your financial freedom by providing you with valuable investing tips and strategies. Ray Dalio, one of the greatest investors of all time, has come out and stated that we are at the end of the long-term debt cycle, which lasts approximately 60 to 80 years. Thus, a potential crash or market depression could be on the horizon.
Tell us, if you would, how debt cycles unfold, and if you would, where you think we are in the current debt cycle.
Well, first of all, I think that there's productivity that we evolve and we learn how to do things better and raise our living standards. And then I think there are two major debt cycles around that. So the wiggles that we see are mostly driven by debt cycles. And they're cyclical because when you give credit, you give buying power. So it's a net gain. When you take back and you have to pay, it's cyclical. And so there's a short-term debt cycle, which we call a business cycle. We're used to that. You have a recession, central banks stimulate monetary policy, and then you go up, and then when the economy becomes too hot, you put on the brakes and you have that cycle. Right. We're well acquainted with that cycle, although I think it's interesting to talk about how it might be a little bit different this time. Yeah. But anyway, it's interesting. Then there's the long-term debt cycle, which is the accumulation of that. And as debts rise relative to incomes, and in order to reverse that, interest rates keep going down, you hit zero interest rates. And when you hit zero interest rates, the first type of monetary policy, what I call monetary policy 1, doesn't work, and you go to the second type of monetary policy. And that is central banks printing money and buying financial assets, which causes financial assets prices to rise and credit to go out. Quantitative easing. Right. And when that ceases to work, you go into a new type of monetary policy, which I'll call monetary policy 3. We'll talk about what that looks like. But it's important to then say, where are we, right? Exactly. Where are we is we are relatively late in the shorter debt cycle. We can tell by operating rates and unemployment rates and so on, fairly well along in there. And we are very late in the long-term debt cycle, meaning the capacity of central banks to ease monetary policy is limited. So what does the historical record tells us when we get to this converging end of the short-term debt cycle and the long-term debt cycle? I mean, are we in for another debt crisis? The most recent analogous period is the 1930s. Yeah. And it's analogous in a number of ways, okay? So the parallel, 1929 to 32, debt crisis, interest rates hit zero. 2008 to 2009, debt crisis, interest rates hit zero. The only two times when central banks printed money and bought financial assets and caused the recovery was from then, 1932 to 1937, and the expansion that we've been in. During that period, we also, as a result of this condition, had a widening wealth gap and a widening opportunity gap, and we had populism, very much like today. Very similar circumstances. But so history doesn't always repeat itself precisely, but are you suggesting that we could see something unfold, both in economic and in sort of political terms with populism, what we saw in the 1930s and with all that followed from that? Yes. I'd just like to take a second and show the parallels. Yeah. And it's correct that history doesn't necessarily repeat itself, but the cause-effect relationships are the important things to understand, and they are analogous. So on monetary policy, the question is what happens when you hit zero interest rates and quantitative easing doesn't work as well? We have a downturn. Yeah. Let's just play with that, because someday the downturn will come, right? When you have a downturn, the average amount of stimulation was 500 basis points of interest rate. We got about half of that we can do, and then you do quantitative easing. So you can measure the difference between where we are by those measures. Okay. So tell us, what happens next? So what happens next is, well, first of all, if you have a downturn and monetary policy is not effective, the only way of dealing with that is the coordination between fiscal and monetary policy. That's what history is. So just as interest rates, it's as true as when interest rates hit zero, you go to quantitative easing. It's as true that when you hit zero interest rates and you have quantitative easing not working, the only thing that works is the coordination and monetization of deficits.
Right.
Okay, so that is the historical comparison. The big issue there is whether politics can allow that coordination, because in a politically fragmented environment, what history has told us is that there is populism and conflict at this time.
So just to be clear, I just want to be very clear, we've got to wrap up, got to go to a break in a second, but something, again, what happened in the 1930s was the Great Depression, nationalism and war, essentially, at the end of the 1930s. And I know history doesn't repeat itself, but are you saying that there is that real risk of the same kinds of things, with all of the effects that had unfolding in the next
history has shown that when you have a large wealth gap, and you have a downturn, and you have an ineffective monetary policy, and you're required to have coordination of monetary policy, that's a challenge. And when you also have a rising power challenging an existing power in much the same way as the 30s, in much the same way as China is now rising to challenge that those are important factors in determining the nature of the dynamic.
What's the solution? Well, it's known that you cannot predict the unpredictable, and these random black swan events can come out of nowhere. I think we need to put this situation into perspective. 200 years ago, the US didn't even exist. This situation is not as bad as World War II. It's not as bad as the Great Depression in the 1920s. I believe the stock market will recover in the long term, as it has done so many times before. And this is just another one of those opportunities to award those contrarian investors. Warren Buffett also agrees, where he spoke at the Berkshire Hathaway shareholders meeting. So what am I doing? I'm following Warren Buffett's investment strategy with a little sprinkle of Ray Dalio in there. I'm buying and holding assets for the long term. Not every company will survive this crash, and not every company will come out on top. However, some will. And that is where you need to do your research. Not every cruise line will survive, and not every airline will survive, but the ones that do will give you big rewards. My method is to take a low risk, high reward approach, not high risk, high reward. Ray Dalio, one of the greatest investors of all time, offers a great method of diversifying your portfolio. I'm diversifying my portfolio across a number of sectors, both nationally and internationally, with no more than 1% of my portfolio exposed to any individual stock. So if that company does go bankrupt, I've only lost 1%. I will also be keeping a cash reserve to invest into property once this is all over. Now remember, this is not financial advice, and I'm not advising anyone to go and plow all their money into the stock market. Instead, you need to assess your own financial goals, your risk tolerance, and only invest what you can afford to lose. Don't invest any money which you might have to pay bills with or use in the short term. So do you think the stock market is going to crash again? And how are you preparing your portfolio? Comment your thoughts below. Want to know my favourite stock picks of 2020? Check out my playlist below, which includes many great stocks that I personally have analysed and invested in. And if you enjoyed this video, go ahead, smash that like button, and definitely subscribe. See you next time.
Coming in, flex. I just wanna win.